And welcome to today's video. Today we're going to be discussing one of the most riveting topics that there is to talk about within the realm of money, and that's income taxes. Today we're going to be discussing year-end tax saving strategies, and certainly this is not going to be an extensive list of things. But before we get into some of the finer points of how to save money, how to make us more tax efficient, how to prepare for the end of the year and also for 2025, I want to begin with some basics. So many people today in America still really don't understand that we live in a progressive tax system. The government calls it the marginal tax brackets. So in front of us, we have our little bucket here. We're just going to use two different tax brackets. The first tax bracket, where I would say that most retirees in America are falling, is going to be in the 12% tax bracket. Now, this certainly isn't the lowest tax bracket. There's one that's a little bit less than that. But if you're down here, you're on a very fixed set of means. Now, we know that the tax bracket above that 12% bracket is a big jump, where you go from 10 to 12. Now, all of a sudden, you're going from 12 to 22. That's a big tax bracket jump. And so the basic idea here is if we want to be as tax efficient as possible, we want to try to be able to remain within that 12% tax bracket and pay as little as is possible. Now, if you were to Google anything with regards to taxes, what you're typically going to find is that you're being fed this information that the top end of the 12% bracket is at $94,300. But is that really true? Well, for most people, it's really not. If you don't own a business, you don't run a farm, you don't have a lot of tax deductibility going on in your life, the reason that so many people have gone to taking what's now called the standard deduction is because, well, that was the purpose of the Trump tax plan. They changed the codes and they jacked up this standard deduction to such an extent that now most people actually don't do itemizing. What they're going to do is they're going to find a better way of saving in taxes by filing and using the standard deduction. So what does this really mean? Well, if the artificial ceiling of the 12% tax bracket is at $94,300, we know that if we take the standard deduction, we can actually add that $29,200 on top of that number. Now, we got to go one step further. What if you're over the age of 65? If you're over the age of 65, you're going to be eligible for potentially one or two more other deductions. For instance, if you're over 65, you're going to be able to take an additional $1,550 and stack that number on top of these two other numbers. If you're married, which these are married filing jointly numbers, you're going to take that number times 2. And so you're going to stack that number again. What does this really mean to us? What it means is that we have $126,600 of income that we can receive each and every year and still remain within that 12% tax bracket. That's great news. Now, the second thing that we want to discuss as far as basics is this. You'll hear people complain about going into the 22% bracket. Well, let's say that this is you. And let's say that you tally up all the income that you've received from Social Security, your pensions, your rental income, your investment income, and all of a sudden you realize that you've got $127,000. Is that the end of the world? Does that mean that now all $127,000 is being taxed at the rate of 22%? The answer is no, not at all. In fact, this is why they call it a marginal tax bracket or a progressive tax system. You're going to pay 10% on some of your income. You're going to pay 12% on the bulk of your income. And then guess what? Because you're at 127, you're only going to pay 22% on that $400 of extra income. That's what drove you into the 22% tax bracket. Now, tax saving strategies. What do we want to do? Well, if we look at what our country has done in the past, it's been pretty famous for spending a lot of money. And this has given us a lot of indication as Americans that chances are taxes are in some way, shape, or form at some point going to go up. Now, we don't know about the next 4 years. Maybe taxes are going to go down. But if you have the concern that taxes are going to go up in the future, here's what I would encourage you to do. Let's say that you don't have $126,600 worth of income. Maybe you're only at $120,000. Maybe you're at $110,000. The reality is it's going to be a good idea to take money or withdrawals from your pre-tax accounts in order to fill up this tax bracket. So let's say that, for instance, you know that you're only in a position where you made $110,000. Well, think about it. You could pull in another $16,600 and still only pay 12% on that money. Now, another thing we need to bear in mind is oftentimes people are working, They're contributing to employer plans like 401ks, 403bs. Well, realize that if you're retired and you're still maintaining those employer retirement accounts, but you're drawing income from them, chances are you are overpaying in taxes. The reason being is your retirement income might only put you into the 12% tax bracket, but when you withdraw from a 401k, when you withdraw from a 403b, you're going to be paying a mandatory 20% federal withholding. Now, if you live in a state unlike Iowa, which doesn't tax on IRA withdrawals and pre-qualified retirement withdrawals, well, guess what? You may be paying 20% to the IRS on that 401k withdrawal, plus maybe another 10% to your state if you live in Minnesota or Illinois or Missouri. So bear in mind, this is the reason why, if you want to save taxes in the future, rolling those dollars tax-free from that employer plan into an IRA is going to help you save taxes. You're going to be able to pay taxes at the rate in which you truly are residing. And if that's the 12% bracket, well, guess what? That just saved you 8% of taxes that you didn't have to take out of your account and you didn't have to give it to the IRS. Now, another thing is, let's say that you are a business owner. Let's say that you're a farmer and you have an extensive loss on your operation this year. Well, guess what? If you have a huge loss in your business or your operation, that may give you the opportunity of withdrawing from these pre-tax accounts and potentially not even paying any taxes. Okay? So don't forget to utilize a loss on your operation or on your business if you have one. It is a perfect opportunity for you to pull taxable money out without paying potentially any tax on it. Now, what if you are in a situation where maybe you're right at the line and here you are and it's end of the year, you've got to take a required minimum distribution, and you just know that if you take that RMD out of that IRA or out of that qualified account that you have, it's going to pop you into the 22% tax bracket. Now ask yourself this, do you really need that RMD? If you don't, this is an opportunity for you to do a charitable donation. Now, a charitable donation is something that you can do it one of two ways. You can do it the right way or you can do it the wrong way. The wrong way is taking the withdrawal, putting it in your bank account, and then writing a check and putting it in the tithe plate. The right way is to have the custodian that has their name on the money along with yours and ask them, like Fidelity or Vanguard, to send that money directly to the charity. And guess what? As a result of that money going directly from the custodian to the charity, it's not going to put you into the 22% tax bracket. In fact, it won't even affect your adjusted gross income. The last thing that I want you to consider is Roth conversions. Now, again, this is not an extensive list, but I would be remiss if I didn't talk about Roth conversions. Roth conversions are taking money out of the left pocket, putting it in the right pocket, taking money out of a pre-tax account and putting it into a tax-free Roth. Now, when you do that, that is a taxable event. But I want you to be thinking about this. For instance, if you live in the state of Iowa, there is no income taxation on a Roth conversion, kind of a cool thing. You'll still have the feds, but not the state. But let's go back to our tax bracket thing. Let's say that you're in that situation. You got $110,000 of income and you're looking at this pre-tax money that you have. You're not 73 yet. You don't have to take an RMD. That's a perfect opportunity for you to convert $16,600 out of that IRA and into that Roth. And guess what? You'll be able to do it only paying 12% federal income tax on that Roth conversion. I hope today's video was helpful. Hopefully it gave you a few ideas. This is the reason why you work with a fiduciary, someone who can help educate you about the things that you need to know. Oftentimes CPAs are great people, but you have to know which questions to ask them to get the right answers. If you've liked this little video, we encourage you to give us a thumbs up, share this with your friends. And if you like our videos and want to see more of them, I encourage you to hit that subscribe button and we'll make certain to notify you each and every time we have a video. I'm Matthew Johnson. Thank you so much for watching. And remember, it's up to you to make today a great day.